Welcome to the True Wealth Podcast, where we specialize in helping aspiring homeowners break into the real estate market and help investors create and build wealth through real estate. We will be sharing some of our best advice around real estate so you can purchase your first home or reduce taxes and achieve financial freedom. Your host, Seun Adeyemi, is a certified financial planner, mortgage professional. Financial freedom is possible when you have the right mindset, coaching, advice, and community. So, let's get real.
Welcome to the True Wealth Podcast. I'm your host, Seun Adeyemi. Today, we are continuing our conversation. This is part 2 of a 5-part conversation we're having with Share. If you missed the first part with Andrew Kim, make sure you check out the previous video. And the first episode, we talked about why the US market is definitely more lucrative than the Canadian market. But today, we want to focus on tax structures. If you're going to move into the US real estate market as an investor, what are the different ways you can possibly own your real estate? What are the different advantages, different disadvantages? What are tax implications as Canadian? And to talk about this, we have Carmen, our CFO of Share, who's going to share her insights with you. She has a lot of history. She has a lot of knowledge and understanding of this. And so she's going to help us break down different tax structures and ownership structures. Carmen, how are you doing today?
Good, thanks. Thank you for having me.
You're welcome. Thank you for agreeing to do this. Before we get into the meat of the episode, tell us a little bit about yourself. How did you get into real estate? What's your background like, and especially the U.S. real estate market?
Oh, well, that's a long history. So started my career with corporate, Price Waterhouse, got my tax specialist designation there, CPA. Then as I got married, I decided to branch off into entrepreneurship, joined the family business in the financial service industry. And having that tax background and learning the products very quickly, having structure and tax really was an enhancement to the investment world. So we teamed up with investment advisors and brought tax and estate planning to their team. After having the first child, I came back into the workforce with the idea of getting investment license. So joined a very large brokerage firm and still didn't handle, although we had the investment arm, still focused on more tax and estate planning and building wealth management centers across Canada.
Right.
And that was really important because the idea for me of integrated financial service was really key. Everything was too much in silos in the financial service industry. So integrated financial service was born. Fast forward, decided to move to the US when the third child was born, not when they were born, but when he was about 4. And I just wanted to slow down a bit, but we had video conferencing machines in all our offices. So I thought I could do it across the border. Florida had a lot of Canadian clients. So we continued to introduce integrated financial services as a concept to Canadian clients in the States. Enjoyed that life, but couldn't keep the full securities licensed. So retired and sold the business. And that's how I got into the real estate market. I was very fortunate to have the opportunity to have capital from the sale of the business and the down cycle of the market, because I really started my investment journey in the real estate side in the crash of 2008. And at that time, and shortly after, mortgages were very tough to get. So it was good to have that cash to be able to buy in. So that was my foray into the U.S. market. Never looked at anything but the idea of replacing my cash flow because I had this trailers from the business and assets under management. So to replace that cash flow real estate made sense to me. It gave me a monthly income. It felt more like retirement than I had when I had it on paper. So that's my foray into that. So then we started another company years later, 2012, called Global Integrated Wealth, where I teamed up with a real estate agent as well as a property management company. So since they had both, we started to expand and introduce it to friends and family in Canada. And at that time, it was nice because the dollar was at par. Soon, I think 2012, we started to shift in currency. And that's when we started to explore more of the financing routes. And so we tried to build an end-to-end for financing entities, all of it turnkey, if you will, but it wasn't scalable. So again, fast forward, we have Share 2020. Not only became CFO, but co-founder in an automated system that can help not just individuals buy real estate, but to be able to scale it up in a fast enough time frame to get to that retirement or financial freedom a lot faster through an asset class that's pretty stable. And that's what I'm looking for. If I'm going to borrow money, I want to make sure my capital is protected and I've got this good cash flow to sustain me for retirement.
One of the things I like that you said probably like 10 times just in the first 5 minutes is cash flow. And for us Canadian, that's almost kind of foreign because, I mean, I started real estate probably 2006, 7, but my first property around there. But cash flow, even as far back as then, has always been something to do in Canada because, I mean, when you look at the prices and by the time you rent it out, cash flow is very, unless you're putting a lot of down payments or you're buying the property cash. Cash flow is one of those things that is hard to come by. And so when you start with a conversation on cash flow, especially with your background, having an investment license, and your thought process was, okay, now I've sold my business, there's those residuals that usually come from having an investment license are no longer there. I think for you more than anybody else, the idea of cash flow was more prominent. Now, so how did you lean into that? Because and talk about why that's even more possible on the U.S. side than on the Canadian side.
Well, and that's the key, I think, is there's more entry-level properties that give you that positive cash flow. And remember, even for me, I was dealing with a lot of senior clients. So not only safety of asset, but that monthly, consistent, predictable cash flow was key. So for me, my search was only in that market. Today, of course, you can go both ways. You can buy an asset for appreciation and then, fix it up and refinance and build that way. I started more cash flow as my base. And then from that cash flow assets, we started to not only use the cash from that to purchase more, but we refinance properties that are good cash flow properties to buy assets that might be less cash flow, but more appreciation. So I go the reverse way. And I'm always looking for balance because as an advisor, you're always looking for both. How do I get cash flow properties and how do I get some assets that are maybe not as high in cash flow, but good in appreciation? And that balance and diversification is going to be key as we move into different areas and different asset classes within the single family market, right? But one of the key things that you said is this mindset of cash flow, I think, is what's critical. At the early stages of my career, I used to always ask, what's important about money to you? Because I wanted people to resonate with what value, what's the purpose of money to them? And that value system had to be built into the plans that I did. Right? Because that's the only way you're going to get to where you are, because there's never a shortage of money. There's always a shortage of reasons, right? So if you have a good reason, a why, how and what will come. And that's what we do. We can show the how and what, but the desire first has to be there, right? So that question about what's important about money to you changed for me when I started to get into real estate and cash flow assets, because now I ask what's important about cash flow to you. Okay. That little shift in mindset is huge, because a money mindset and a cash flow mindset are very different. One says cash is king, the other one says cash flow is king, right? And that slight difference is a big shift for many people, right? Because the money mindset's almost what we grow up with. We learn to go to university, get a job. That money that we make is almost like for spending and some rainy day for retirement. So it's always a spending mentality. And I just found a lot of our clients, even at retirement, had this fear and lack all the time, because it's always about how much can I spend from the assets I have. Okay. When we shifted to this cash flow mindset, you go into what we call a creation mode, right? And that creation mode doesn't stop. I'm retired. My kids have seen assets from a very young age. They get cash flow from their assets they each have by themselves, as well as with their siblings or their cousins. And so cash flow is already there for them. But why do they still think of creating and buying more? Because they're not in a mode of, just stopping for spending. They're gone beyond that. Right. And the people that have that cash flow mindset, their destiny is very different. Right. And so when we look at stages of wealth, I always say most people will stabilize themselves. They'll get out of survival to stability, and they'll move to the idea of security and this financial freedom, but then they plateau. Right. And I want to take that 98% and shift them into success and significance by, continually being creative and really create these cash flow assets. Because at some point, when you go into this creation mode, the assets will then help you build on their own.
That's right.
We call it a critical mass. And the idea behind it is, how do I get to a point in time where I'm no longer putting my money as a down payment to buy a property, to give me cash flow and renovate and do all of that? How does my assets provide me enough collateral to refinance and buy more?
And I think that idea of critical mass is a concept that is still foreign, especially to a lot, because in the initial stages, you're putting in money there. You're investing your hard-earned money. You're concerned. Okay, am I going to generate appreciation? Which is, I'm talking as a Canadian here, because we're so accustomed to this wild appreciations that we're getting in the real estate market, at least up until like 2022, and then refinancing and either selling or and then buying another one. But when you're talking about critical mass, you're talking about investing for the long term, whereby the properties are generating enough cash flow that at some point, when you need to scale that real estate business, you're not putting your own money in there. It's the properties themselves that are funding acquisition of more properties. Am I correct?
Yes. Yeah. So to give you a quick example, 2021, 14 assets were purchased. 21 to 23, only 2 years later, those assets grew in value, and we took not all the assets, only 9 of them, and the cash flow from that became 50% of the value, 600,000, and we just bought another 2 properties in Texas for 300,000 each, but no money out of our pocket.
Wow.
Right. So how do you do that? It's because the cash flow assets, and then the new ones that we purchase more for appreciation together were enough for the financial institution to feel that cash flow is enough to lend us. Right. So in America, and that's the thing, the financing is going to be key too. In America, they will lend on this the idea of DSCR. So your debt service ratio, if it covers, they're good. They're lending on the property. They're not lending on me and my income anymore. So you're able to build a lot faster. Where in Canada, and I always say you have to start somewhere. So I always say start with the HELOC, because you're going to get the best rates on the home equity line of credit. And once you've capped that and used that for your down payments to purchase properties, they'll allow you a second property, like the RBCs, the TDs. They will allow that second, third property based on your income, but then you're capped. So how do you go beyond that? And I think in Canada, it's more commercial loans where you get them only if you have 5 to 6 properties. Well, in America, your first property you could be buying on this type of financing, right? So financing's key to be able to scale and build, right? The first property is, testing the waters and maybe proof of concept. But when you want to go beyond that, the financing available in America is far more creative than it is here in Canada.
Right, because you're not relying on your personal income and even your personal debt to service ratio. They're looking simply at that property and its ability to service itself, which makes scaling a lot easier in the US than Canada.
Which also then means you need the cash flow, right? You got to find the right assets. And that's where Share comes in. How do we find those right assets based on data points, right? That can not only give you good cash flow, but we're looking at the marketplace, the employment rates, the ability to increase rents. Where do we have that ability to really build our base to have that good cash flow as we start to increase rents and things like that, where then we can leverage again, refinance, and build more.
So for the Canadian who is then now looking at buying in the US, the question often comes up, how do I do this in the most tax efficient manner? Do I own in Canada, there's really just 2 ways. You own it through a corp or you own it personally. I know that on the US side, there are a lot more options. So let's talk about what that looks like and what option fits what kind of investor.
Okay. For me, I always look at 3 considerations when you're looking at entities. And the first one and main one is tax. So you brought up tax, and that's a good starting point. But we also look at asset protection, because sometimes asset protection might be more critical than the tax situation. And then the third one is also, how do we pass this asset on to the next generation or to our heirs? And so looking at probate, estate planning, estate taxes, because America does have an estate tax on top of capital gains tax. So looking at those 3 main areas is part of entity formation. And the biggest key to any entity is the objective of the person buying, right? So the first step is, what is the objective? Is it long-term? Is it for capital gains, for appreciation? Is it a one-time thing, or is it a portfolio you want to build there? Those are all considerations when you're looking at entities. So I'll go through basic ideas, and no different than Canada. We either go individual. So the problem with individual, and I usually cut that out right away, whether it's Canada or the US, if we're going to rental properties, right? If it's your personal home, if it's your vacation home, owning in your personal name is fine, because you're not worried about liability. But the moment you get into rental properties, it's good to have that asset protection, creditor proofing, and all of that starts, and that's why the entity. Okay. So when we talk about entities, I always say own nothing, but earn everything. Okay, that's your critical concept, because if you own nothing, then you've already mitigated some of the estate planning issues because it's not in your name.
That's right.
You've already mitigated things like incapacity because you've already in your shareholders agreement, or you may have a general partner taking care of it, or you may know who the next player is. You maybe have successors, is what I'm saying. Right?
That's right.
You don't need that secondary will if you've got an agreement already in place. So there's a lot of probate and estate planning automatically in an entity formation because of agreements that are set up. Okay. But then the question is, what type of entity?
Yes.
Right. And so I will go with, and I usually try to go with the most common in all states and all provinces, because you're not only talking about Canada, US, but each state, each province has very different entity formations. Right?
Right.
And so what's the most common if I'm going to diversify and buy more than one state? I want to have something that's neutral to all. Right. And so so I'll talk about two, which is the corporate structure and the limited partnership structure. Okay, because those are both available, both sides of the border, every province, every state. Okay. The only one I'm keeping out of the conversation as a to build your whole wealth building in real estate is what they call a limited liability corporation, an LLC in the US side. Okay. And the reason we kind of keep that out of the equation is because it can be used, and we do use it in our structure, but it's not the place that you'd hold the active business of real estate and income and all of that, because there's a mismatch. We don't have an entity like that in Canada. And so if one is flowing the income to the individual and Canada's saying, no, it's a corporation and you got to file it like a corporation, then you got a mismatch of timing. And so you may not get the foreign tax credits, and it leads to what we call double taxation if it's not done properly. Okay. So if I'm building an active business, like in Canada, corporate rates are better. And you can use 25-cent dollars, pay 25% tax, and keep the rest in the company to keep building. So if we're active in real estate, corporation's great on either side of the border. Okay. But if you're passively investing, because you want to be on the US side, but you want someone like ourselves who are asset managers or property managers taking care of everything for you, that's not the ideal situation then, because like Canada, America, all countries, they want to charge a higher tax on passive investment corporations than they do on active business income. Okay. And so there's a lot more compliance and forms to fill and various type of taxes, because even if you want to defer the tax, Canada wants to have an accrual system where you pay the tax right up front. Right. So investments, even in Canada, if we had an investment company, it is taxed at full rates at 50%. And as you pay it out, you get dividends back. So reverse of an active business where you got low rates and you don't pay the tax till you distribute.
You distribute, but on the holdco side, you are.
Yeah, so the holdco equivalent is what they will do if you have a C corp in Canada, in America.
Oh,
okay. So that's why we avoid having the corporation, and sometimes it's okay. Again, it's individual, and so if you're active, I have no problem with it. But in a passive form, I like the limited partnership. Okay. And why the limited partnership? It kind of acts like the operating company and the holding of the asset in two separate. So the limited partnership would hold the asset, and that's where you'd finance and do all your, that's the one that's going to hold. But we have a general partner and a limited partner. The limited partner are the individuals investing. Right.
Okay. So break it down for the very non-tax savvy investor. Okay. You are buying this property in the US. You set up a limited partnership with you as the limited partnership and the general partnership entity owning the property in the US?
No, so the reverse way. So the limited partnership, so there's, unfortunately, the terminology is partnership versus partner. Okay, so there's a limited partnership that'll hold the asset. And then you've
Okay.
got two partners. One is the limited partner, the individual, and then
Right.
the general partner, who's going to be the one who, almost like your asset manager, they can get the
Okay.
management fee, they can charge a fee if they're actively participating in managing that property.
Okay.
Okay, so the general partner is okay to have a C Corp or an LLC there because it will be the active partner. Okay,
Mm-hmm.
the limited partner is then limited in its liability to the asset you put in. So that's the protection side comes in, right? So now if I've
Right.
put in 50,000, that is the most that someone can come after me
At risk.
for. Yeah, because you're limited. That's the idea of a partnership and limiting the liability.
Mm-hmm.
Okay, a general partner doesn't have that same, that they're unlimited liability. That's why we form an entity on top of a general partner.
So you have the partnership, the general entity, and then you have the limited partner who is the investor, and they
Yes.
have the general partnership because they're the ones actively managing the business. There's an entity above that to also further shelter them from liability.
Yes, and I see that in Canada a lot. Well, they'll build two entities under the individual: the active one, which is management, and the
Hmm.
passive one, which is the holder of the investments. So
Right.
similar concept, just a different form.
Okay.
Hmm.
Okay.
Hmm.
So when you said that the type of structure would determine what the objectives of the investor are, what do you mean by that?
So the when I'm looking at the type of investor, so a lot of people are asking the question. So if I set up that entity, and usually we'll set up in a state that's very protected and the lowest cost. So we tend to set up in Wyoming. But if, let's say, I want to buy a property in Texas and I want to buy a property in Florida, I want to go off to Georgia. So that objective needs to be understood to decide how do we then take that entity and buy in these various states. Because remember, each state wants to tax you themselves, right?
Correct.
And so basically we have a foreign jurisdiction we're working in. So I could either take that limited partnership and say, you know what, I want to own a property in Georgia, and I can foreign register my company there to do business.
Mm,
So we need
okay.
to understand the objective. Are you buying one property, many properties, many states? Right? So I could either take that entity and foreign register to buy properties, or I can keep that as my holding company, and under each of those create a new entity to hold all the Georgia properties, all the Florida properties, all the, right? So those objectives, once we understand it, and some of it you build as you grow. You don't have to have all those answers today. That's what we're here for. You start in an area that you want to, start building your portfolio. As you decide to diversify, then that's the objectives I'm looking for. Then we start to add, and so having it as one entity and foreign registering might be the easiest at the beginning, but eventually you may want to have each entity hold separately to protect
Hmm.
even more those
More
assets
protection.
separately. Hmm. Hmm.
So you answered one of the thoughts I was going through my mind is once you start a specific structure, you can always kind of change it as your portfolio changes. For the new investor looking to get into the real estate market, they may start with a certain structure because that's the most convenient and the most cost effective, let's say. But then as they want to expand, let's say to different states, buy more properties and get to that critical mass stage, you can always tweak the structure to own more through any of those entities.
That's right. That's right. And that's what I'm saying. At the beginning, you're going cross border. You want proof of concept. You want to, and some people right away know they've got the cash to build a portfolio. And so they may already have an objective. And so looking at the intention, again,
Hmm.
is it buy and hold? Is it a lot of, is it appreciation that's more important, or is it cash flow? What's the income levels of the individuals today in their personal name?
Mm.
Those are criteria that could determine, do we change the structure. But the most common structure is going to be that the limited partnership for, as I said, not only the various states but for various income levels and types of assets.
So how does that income then flow, depending on how it's set up in the US, to the Canadian when it comes to their income tax and tax liabilities?
Well, that's a good question, because of course now Canada also wants its share of the tax, right? So what we have to understand from that aspect is there's two residents here. you as an individual, where do you reside? And the asset itself, where does it reside? Okay, so that's the critical way to think of how you pay your taxes. So if I'm a Canadian resident, I pay tax on a worldwide income. Okay, if I have a property in Texas, well, then that property in Texas also has to pay taxes in America.
Correct.
Right? So you've got the American tax. Anything that flows to the individual, when you come back to Canada to file your tax return, you're just pretty well converting to US currency to Canadian currency. And you're filing the same income, expenses, all of that. The only difference is the depreciation. The calculation of depreciation is a little different in America and Canada. But otherwise, all things being equal, you've got your income, you've got your property tax, insurance, all the expenses. Your net income is now in your Canadian return. And if you paid any taxes in any of the states or federally in America, you get a foreign tax credit for that. So you'll never pay double tax.
That was my next question. How do you avoid the double tax? Because your entity in the US has already paid the tax.
Yes.
Now you receive the net income personally on your T1 to file your taxes and then get taxed on it again. But with the foreign tax credit, that eliminates that tax on the Canadian side.
That's right. And that's again, if it's held personally. If we're going the corporate route, and I'll just say, let's say we're active first. If I'm an active business and I have a corporation, I don't ever pay the tax while I'm building, but eventually when I pay myself a dividend, then I pay the tax, right? Sorry, go ahead.
Hold on, let's rewind. So if I'm an entity, so let's say the income I'm receiving from the US is flowing to a corporate entity in Canada.
And that's what I was going to say. So because America doesn't have an integration, you'll pay tax in the company. And then when you pay yourself a dividend, you pay tax again. If I'm going to do a corporate structure, I like it through a Canadian company because we do have an integrated tax system. And so the dividends flow to the Canadian company and follow our Canadian rules. And so as you pay yourself a dividend, you get a dividend tax credit for anything you've paid at the corporate level.
Correct. Okay. Which is, so that means, just to help our listeners better understand it, it's possible that the income flows to you personally and then you put that on your T1, but it's also possible that the income flows to a corporate entity through a dividend, which if you then take out the dividend from that, you then, there's the dividend tax credit that you get. However, does it even make sense? Because if I'm trying to buy real estate in the US, to start setting up Canadian corporate structures. I have my opinions on that, but I want you to kind of give us insight. What would you think for a new investor, or even for an investor that over the next 2-3 years, they want to buy 3-4 properties? Should that income come in from the US? Should that be flowing to me personally, or should that be flowing to a corporation where I can leave the money to grow in there? Like, I guess I'm kind of answering my own question. It all depends on if you need the money in Canada. Would determine
one is the need for money, right? Because of course, if it's and the second is the tax rate. So if the tax rate's high on investment corporations, very hard to leave it in there because they're encouraging you to pay yourself a dividend and get a refundable tax credit when it's a passive investment, I'm saying. So whether you're actively involved or passive is going to be the key. And then the second one, like you said, the criteria: do you need the money or can you keep it there?
So, but for the US investments to be an active income, it will also mean that my corporation on this side is actively involved in real estate investing. That's the only way I'm going to get that small business deduction.
Exactly.
Lower tax rate.
Exactly. So if we're talking about passive investments, because I think going across the border and into various states, I would hope you're going to be passive, because very hard for any retail individual to organize enough across the states for contractors and builders, and so too much involved. So you're going to give it to a pass. You're going to go more into a passive mode for most of the business, I'm saying, right? So it's best to think of the passive corporation as the entity. And then, as I said, that general partnership is the only piece that I'm going to bring back to Canada, right? So that piece is active because you're, managing on top of any managers, if you will. So in my opinion is, if you have a holding company already, because many people that are in that active business, they might have already started to set up their holding companies separate from their active business. Right. Because you really don't want to take passive investments with active business, because you could lose that status.
Correct.
Right. And so separating it out is going to be the key. So if they've already got a holding company, that's the company that could hold these assets. If they've already got a holding company, but they're in other, I don't know what other type of businesses, and they want to separate just real estate as a separate one, they could set up a new holding company just for the real estate business. So sometimes we're using the existing corporation that might be a holding company that has money that wants to invest. Other times we're setting up a whole new entity if they don't have that already. In Canada,
And
I'm saying, as
in
a holding
Canada,
company.
but for the newbie investor, it's better for them to receive that income personally, at least to start with, because they don't have critical mass yet.
Yes.
Because of the tax credit, even when they receive the income personally, there's a tax credit they would get, which kind of negates double tax.
Well, and you brought up that point, but I'll bring up one more that says to me, start in that personal limited partnership where you're getting the personal income. Remember that real estate, and that's why a lot of people it's a wealth building concept. It's not only keeps up with inflation, but it's got great tax advantages, right? And so in those early years, even if you're in a positive cash flow, your taxable income could be negative. So let's talk there, because understanding that's critical, because what if you had a negative cash flow and you could use that against employment income in the personal level, right? Until you have enough positive cash flow, maybe you want to stay personal. So test the waters, make sure there's always planning opportunities once you see yourself earning too much on top of your employment income. So let me focus there for a little while. What's the difference between your net income, your cap rates that you're talking about, and I might be having a positive cash flow, but my taxable income may be a very different amount, right? So if I just take a simple example, I own a $100,000 property. 80% of that we say is the building value, right? And the building value you have to take depreciation. In America, you have to take depreciation. In Canada, it's an election. Okay.
Gotcha.
So if I'm taking depreciation and it's around 5%, I mean, it's a number of years. It's a straight line calculation in America, but I'll go with the Canadian version because that's in the end, you're going to use the depreciation at the Canadian rates. It's 4%, right? So you get to deduct that and bring your taxes down. Right. So you take your net income, you take this depreciation. If you borrowed for investments, that's another advantage Canada has, right? If we borrow for investments, all that interest is also deductible.
Correct.
Right. So by the time I have interest income and depreciation, I might have brought my net income down to zero or negative.
So you're actually in the positive now because you're not paying any taxes on that.
Exactly. So if I'm not in a taxable position yet, why think of a corporate entity? Why not flow it individually? You've got the protection, and and once the cash flow is too heavy, then you might consider other entity creations if we have to. But I would say at that early stage and entering into America, the limited partnership in personal name for the limited partner is fine.
Is it possible to bring in your negative cash flow from the U.S. side to help offset your personal taxes on the Canadian side?
Well, yes, and that's what I was saying. So if it's a negative cash flow, when you're filing your Canadian tax returns, you can use that against employment income or other forms of income, dividends, or, you can't create a loss with, depreciation. But you do have, if it is negative in cash flow because repairs, and remember with real estate, that's the beauty of it. If I find someone's having too much cash flow, I'm saying, well, then they haven't really started to scale up their portfolio, refinance and buy some more. So the interest portion of it, it's good debt. And if it's good debt and it can make you more than you borrowed, it's worthwhile refinancing and doing that again to bring that taxable income down again.
So what about an investor who doesn't really need the cash flow? So they're generating $12,000 a year, about $1,000 a month, $12,000 a year in net cash flow. What would you suggest in terms of, do they leave that cash flow on the U.S. side and not bring it into the Canadian taxes? Like what do you usually see people do?
There isn't a concept that you can leave it on the U.S. side, right? Okay. Because in the end, remember what I just said to you. If you leave it on the U.S. side, they're still going to accrue for it here on the Canadian side. So if you do a C Corp and you want to accrue it, to date, we still have an advantage because the American tax rate is 21%. I'll say the average state is about 5%. So let's say you're paying 25% tax. Today, even if you're accruing, they're okay with a jurisdiction or a country that's paying 25% tax. They were leaving us that way. And so you could invest the difference in a corporation and, use that 75-cent dollar to reinvest. But the budget of 2022 has brought up a calculation where they want to change that to make it equivalent to how Canadian investment holding companies are taxed. And so they want to bring it up to the 50% rate. When they do that, there's no advantage, is what I'm saying, to keeping it there.
Yeah, that makes sense.
I mean, you can keep it there to reinvest, but I'm talking from a tax perspective.
Okay. So, I mean, when there's too much cash flow, there are things to do to bring down that cash flow, at least in the short term.
Yes.
Like reinvesting, refinancing, and hopefully
And
even
sometimes those are better strategies than selling and capital gains tax or incorporating, because you've got tax isn't the only, or structure isn't the only way to mitigate taxes, is what I'm saying.
And when you talk about, I mean, the corporate entity is not simply for taxes, asset protection. When you're into the investment real estate, there are liability exposures that an investor has there. And so the corporate entity helps inform how that is set up. And then there's the estate planning piece of it is, if you're no longer in the picture, how does this asset, does it remain, does it remain within that entity? Does it get sold? Does it pass on to a new shareholder? And all of those considerations.
Well, that's the beauty of, as I said, shareholders agreements, succession planning. Usually in the agreements, you can take care of a lot of those aspects of it. I'll say the caveat of a limited partnership is they could look through a limited partnership and say you own it, not the entity, because it is a flow-through entity and it does go to the individual. So there is some that say, I mean, for estate planning purposes, IRS could charge estate taxes when it's held through a limited partnership. Today, though, we have an exemption in America for $13 million per person before you fall into that area. So if you've got a very wealthy client, yes, you're going to consider that as part of your planning. Okay, because although it's 13 million today, they've been talking about it for many years that they want to bring it back down to 5. It's targeted for 2025 again, but that's been talked about a lot and it's still not done, right? So you can't plan for only today's values. They can change that amount for state tax purposes.
So this has been a lot for a lot we've covered. I know you have a workshop coming up on the 29th. Can you talk a little more about that? Because I think on that workshop, you'll be able to even get into more details, and it's a webinar. Can you talk about that and how?
Webinar across Canada. It's from 8 to 10 Eastern Standard Time. Our objective is to not just cover a little bit of tax and understanding the U.S. markets. Dimitri's there as a RCI Chief Investment Officer, kind of give you an idea of the data points we use to the buy box for the individuals and how to look at certain marketplaces. And but I think the key concept for that webinar is going to be how to get to $10,000 of income. What's the game plan? Some people may be able to do it immediately if they've got the cash flow, and others may need time to build to get there. Both concepts will be talked about. So I think it's a nice introduction to not just real estate for wealth building, but for cash flow to eventually retire and have that income stream to get to that financial freedom.
So I was just looking at the dates. The 29th is 2 days from now. There's a chance this podcast will not be released before that workshop. Will there be a recording of that workshop? I can probably put it in the show notes for our listeners to go check it out once this episode comes out.
Sorry, say that again.
I was looking at my dates here, and the 29th, which is 2 days from now, this recording is on the 27th. So by the time this episode comes out, that workshop would have happened already. Will there be a recording for that workshop that we can I can put in the show notes?
Sure. We'll get that to you.
Carmen, I think this has been a lot of great information. Different strategies for different types of investors, depending on what your goal is. But the key piece to take away is there are tax advantage structures that can be set up depending on your goal. If the goal is capital appreciation, if the goal is receiving income, how does that play into your Canadian tax? This has been very informative. Carmen, I really thank you for your time. Anything else you want to add before we wrap up?
No, we're here. Our whole objective is to make buying real estate as easy as buying a mutual fund. So I hope we reach our objective and get you to financial freedom.
And if all of this was still a blur to you and you want to learn more, book a meeting and we can talk about your specific situation, exactly what you want to do, and even break it down further as to what structure best suits you. You've been listening to the True Wealth Podcast. Thank you very much for joining us. See you next time.
This is all the time we have for today. Thanks for listening to the True Wealth Podcast. Don't forget to rate, share, and subscribe to the True Wealth Podcast on your favorite podcast platform. Follow us on Instagram, Twitter, or Facebook at True Wealth Pod. We'd love to hear from you. Share your thoughts, ideas, and questions with us on our social media platforms or email us at podcast@truewealthadvisors.ca. And who knows, your question might be the subject of a future episode.